Hello and welcome to the UAN Governmental Fund Accounting Course 102. In this video, we're covering the cash management in Chapter 3 of 4. Additional chapters in this series are Uniform Chart of Accounts, Budget Basics, and Transactions. Let's begin. The management of cash is just as important as the management of budget components. As we emphasized in Fund Accounting 101, cash and budget are different parts of governmental fund accounting, and they're managed differently. Way back in Chapter 1 of Course 101, we promised that although governmental fund accounting can be very confusing, if you learned how to manage both the cash and the budget, you're going to obtain that peaceful state of understanding. So let's get to work on the cash. Remember that the cash is all the money in the checking accounts and investments that will reconcile to the bank statements each month. The budget is the operating plan that consists of two components, resources available and appropriations. We are not going to be talking about the budget, only the cash. The fund cash balance tells us how much money we have at this time. Let's explore further with an example. Our sample is a fund with only the semi-annual tax levy distribution as revenue. The chart shows revenue will only be received in 2 months during the year, but the fund has to make payments all 12 months of the year for electricity, telephone, wages, fuel, and other fixed costs. Inspection and training expenses would also have to be scheduled within their required deadlines, but also when there's going to be cash in the fund to pay for these items. If our amended certificate has $62,000 as the total resources available, we need to consider how much money we will have to operate each month. In January, until the first half taxes are received in March, you must operate on the carryover cash balance each month. The fund balances will reduce by the payments made without any revenue coming in. Sometime in March, but perhaps not before the monthly bills are paid, you'll receive the first half taxes, which will substantially increase the fund balance. But spending at this point must be regulated so the cash isn't depleted before the next half tax distribution is received. In order for the next year to begin successfully, you also have to end the year with enough cash in the fund to continue operations in January, February, and March of the new year until the first half taxes are received again. Now don't give up. I'm going to make this easy to understand. Let's use a family vacation for an example. Everybody likes to plan a vacation. Our family established a vacation fund, let's say it was last January, and they've added $334 to the fund each month. This is the second year. They now want to take a $7,000 vacation this year. An amended certificate, if they needed one, shows that sometime during the year the family could take a $7,000 vacation, but it does not show anticipated monthly cash balances. It's a component of the budget. The amended certificate only certifies the estimated resources for the entire year. It doesn't tell you when you will have cash in the bank. The family has to consider cash flow to plan their vacation. On our monthly cash flow chart that you see on the screen, look at how much the fund increases with each monthly receipt. This is a very simple example with the same revenue each month and no expenditures to factor in at this point. We can see that they'll be able to take their vacation in September when that $7,000 goal has been reached. So when you plan a vacation, you have to pay for some of the things in advance. Let's explore this further. Hotel reservations, plane tickets, and car rental are the expenses that have to be paid in advance to take the September vacation. The family has to decide which of the items has to be reserved and paid for first, and when the cash will allow each expenditure. Notice the balance each month, January, February, and March, increases because no money has been spent yet. At the end of March, the fund balance is $5,010. So in April, the family reserves their hotel room at a cost of $1,500. The April ending fund balance is $3,844. In May, the family purchases the plane tickets at a cost of $1,900. The May ending fund balance is $2,278. No expenditures are made in June, and the ending fund balance is $2,612. In July, the rental car is reserved and paid in advance at a cost of $650, and the July ending fund balance is $2,296. No expenditures are needed in August, and in September the family takes $2,950 with them on vacation. All the expenditures, including this last amount, total $7,000, and this leaves $14 in the fund. Fund balance begins increasing again with each monthly deposit, and at year end there will be $1,016 in the vacation fund to carry over to next year. Now the family's happy. This example illustrated how to plan expenditures with cash flow. I hope the vacation example helped you consider cash flow. You'll want to reconsider this scenario when we discuss purchase orders in Chapter 4, because cash flow is often neglected when the appropriations are available for a purchase order. You will need to understand the cash flow of revenue and expenditures in each of your funds and work with your department heads and elected officials so they understand appropriations may be available when the board adopts them, but cash is only available when it's in the bank and reflected by increased fund balances. Make sure each of your department heads understand when the funds that support their operations receive money and what needs to be paid each month so spending can be planned with cash. Now we're going to talk about how a government entity is regulated in the deposit and investment of their cash balance. Ohio Revised Code Section 135 sets forth the laws that define the institutions eligible to be public depositories and the procedures to award an institution the deposit of public monies. We will review important points contained in the Ohio Revised Code Section 135, but we're only touching on the basics of some major points to put you on the first steps. Do not use this training as a complete resource. There are 3 designations of deposits. Your board will make these designations. Active deposits, money needed for the immediate use by the entity. It must be deposited in limited types of accounts in order to be easily available. Interim deposits, money not needed immediately, but needed before the end of the 5-year designation of depositories. And inactive deposits, money not needed by the entity before the end of the 5-year designation of depositories. Review applicable sections of the Ohio Revised Code for specific allowable accounts and the maximum allowable maturity date of an investment for each type. Now this seems simple enough. Your board determines the designation of deposits and you're probably thinking that this really isn't that hard to understand at all. What's the big deal? But this step is rarely understood or followed. In addition, the legislative board is limited in investing designated monies unless there is a written investment policy adopted by the board and on file with the Auditor of State. If a written investment policy is not filed with the Auditor of State, the entity may only invest interim deposit money in limited types of accounts, some requiring limited maturity dates. If your entity has investments, the fiscal officer is required to complete investment training provided by the Treasurer of State. Or there are some exceptions that may allow you to request an annual waiver of training. Once you know what types of investments your entity holds, go to the State Treasurer's website for more information and training dates. If your investments would allow you to receive a waiver of the annual training, you must complete and submit an annual notice of exemption from continuing education requirements with the Treasurer of State's office. You will find that form on their website with instructions to file. Make sure you have attended training or received an approved waiver if you qualify. Auditors will always verify you've met these requirements. The money of a government entity must be held in institutions that are eligible to be public depositories. There is a mandatory process to award the deposit of public monies. Each depository must have a memorandum in agreement for deposit of public funds with a designated expiration date, not to exceed 5 years. Star Ohio is an exception. Star Ohio is the State Treasury Asset Reserve, an investment pool managed by the Ohio State Treasurer. Government entities may invest their money with Star Ohio without the memorandum in agreement or pledged funds. No public depository is allowed to receive and have at any one time a greater amount of public monies than is specified in their application for the depository. A depository must provide proof of security for the repayment of public deposits. This is to protect public money against insolvency of the depository. If your balance in the institution is more than the FDIC insurance, they must pledge an amount to cover the balance of your account. It is important for the governing board to properly approve depository agreements and for the fiscal officer to ensure that all public monies of the entity are secured. You are required to provide auditors with copies of all memorandums in agreement for deposit of public monies, all documents evidencing a deposit that includes the purchase date, interest rate, maturity date, things like that, and the pledged security statements for each depository as required. The next layer of knowledge you need to add to your fiscal officer toolbox is investment type. By investment type, I don't mean the account you opened. I'm talking about the two types of cash balance investments in governmental fund accounting. As outlined in the previous section, the board should designate money as active, inactive, or interim to invest available cash. You do not invest fund balances. Previously, we learned that, as indicated on the Uniform Chart of Accounts, there are funds that are permitted, not permitted, or conditionally permitted to receive their earned interest. Manual bookkeepers as well as accounting software users should be following these regulations. If a fund is not permitted to retain its earned interest, the general fund receives the distribution. There are no exceptions. This is important to remember as we discuss investment types. There are two choices of investment type, pooled and non-pooled. As you can see, the guy on the screen is in a pretty hopeless situation. We want to clear the water so you don't feel like this when trying to understand pooled and non-pooled investments. Let's start with a sample of accounts and funds so we can get the sharks away from your pond. This is a sample, cash and funds from Course 101. Notice on the left are the bank accounts and on the right are the fund balances. None of the bank accounts match a fund balance. This is normal and accurate. Bank accounts do not indicate fund balances. The first three accounts, primary checking, Star Ohio Investment, and the CD, are pooled investments. They're invested cash, not fund balances. The Cemetery Bequest CD is different. Our Cemetery Bequest Fund had a non-spendable balance of $2,000. In this case, the money was donated with a binding agreement. $2,000 is not spendable, but the interest and the remaining balance of the fund is spendable. The $2,000 is invested separate from all other money and attached to and is a part of the Cemetery Bequest Fund balance because of the strings attached by the giver. Now notice the CD is $2,000, but the fund balance is $14,532.55. The $2,000 is included in the $14,532.55. It is not in addition to the fund balance. We will work with these sample bank accounts and funds to further explore pooled and non-pooled. The primary checking account is a pooled account. It holds money needed for the day-to-day operations, but the primary checking doesn't assign cash balances to each fund. Only the fund balance separates the money by fund. A pooled investment does not have fund ownership either. It's simply an amount of invested cash not required in the primary checking to meet the day-to-day expenditures. We invest in order to get a better rate of interest. The investment is opened and the cash is transferred from the primary checking to the investment with no fund designations. Pooled investments are the fiscal officer's best friend and are very easy to manage because they do not limit fund spending from the primary checking account. It doesn't lock down a portion of any fund balance because it's invested. You can post payments up to the balance of your primary checking account and up to a fund balance. The lesser of these amounts will be your limit on each payment. Let's look at our sample again. Now the chart only shows the pooled accounts and the funds with a pooled balance. The non-pooled cemetery bequest CD of $2,000 has been removed from the left side, and the cemetery bequest fund has been reduced by $2,000. This is a list of pooled fund balances. So notice that the bank accounts have no exact connection to any fund balance. They're bank accounts, not funds. The total pooled cash is equal to the total pooled fund balances. So when I'm trying to understand pooled accounts and fund balances, I have to know where to look to answer my questions. So when I want to spend money from a fund, look at the fund balance. You can spend up to the pooled fund balance. Remember, we're talking about cash. We'll cover the additional layer of spending from the budget in Chapter 4. I ask a second question when I want to spend that same money. Is there enough cash in the checking account to cover the expenditure? That is not a fund question. It's a bank account question. Sometimes a large debt payment or a capital outlay reduces the primary checking to the point you need to transfer some invested cash back to the primary checking account. It's simply a movement of money between depositories, not a receipt of new money. Investment transfers don't change fund balances or the overall cash balance. It moves money you already own between depositories. Now that you understand pooled accounts, let's look at a non-pooled account. Non-pooled investments are only used in rare circumstances where binding agreements require a fund to hold an amount separate in an investment. Only funds that are permitted to receive interest can have a non-pooled investment. Our sample cemetery bequest CD illustrates one of these rare circumstances. Remember that our cemetery bequest fund had a non-spendable balance of $2,000. That money was donated with strings attached, and upon receipt of the donation, all the proper procedures were followed to add the permanent fund. It is permitted to receive interest due to the conditional nature of the fund and our agreement, and a CD was purchased following all of the depository agreement laws. The non-pooled investment is owned by the cemetery fund. The interest earned on the CD will be posted to this fund and can be spent from the spendable portion of the fund balance according to the agreement. One fund owns this investment because the binding agreement requires. You would never bind any other fund with a non-pooled investment when it wasn't required. It would improperly complicate the fiscal officer's work. Remember that pooled investment is the fiscal officer's best friend, and non-pooled is only used when required by contract or agreement to hold a portion of a fund balance to earn interest for a specific purpose. UAN support receives many calls about investments. Often, governing boards are not aware of the procedures to follow for investing the entity's money and have instructed the fiscal officer to add a new investment for a portion of one or more funds that are not permitted to keep their earned interest and cannot participate in a non-pooled investment. Here's a sample of what we hear on the support line. A fiscal officer has been instructed by the governing board to open a $30,000 C at the new bank down the street using $10,000 each from the fire levy fund, the cemetery levy fund, and the road and bridge fund. And as we learned in the last section, the board has improperly instructed the fiscal officer in the management of investments. The fiscal officer cannot do as the board instructed due to the following problems. Cash is not invested by fund balance. It's invested by the designation of active, inactive, or interim money by the governing board. It can only be invested in a depository that has been properly awarded the deposit of money and holds a memorandum in agreement for deposit of public funds, and has submitted proof of pledged securities if more money than the FDI insurance is going to be invested with that depository. Not necessarily with just this one $30,000 CD, but if they were going to invest other money at that new bank. None of the funds in the example are permitted to keep their own interest, so they can't participate in any non-pooled investment. And the fact is, a non-pooled investment can only have one designated fund. Now, the board could invest $30,000 in a CD at a bank that holds a proper memorandum in agreement for deposit of public funds, but it wouldn't have fund designation. As a new fiscal officer, you may find that the entity has previously mismanaged investments like the scenario I just described. If the entity has investments, when taking office, you should review the investment policy. Compare the policy to the current investments to see if the policy has been followed. Understand how the policy directs your actions moving forward. Review all memorandums in agreement for deposit of public funds and compare the current balance held by each depository to the agreements to ensure that each depository doesn't hold more than the agreement allows, as well as confirming there are sufficient pledged security with statements on file. If problems are found with these items, form a plan of action with the assistance of the legal advisor to bring the investments into compliance. Bring the plan to the governing board's attention so it can be implemented. Don't forget to check if you have to attend the Treasurer of State's investment training or if you can request a waiver before year end. In Chapter 3, we learned that cash management is different than budget management, but equally important. Spending must be planned with the cash flow and current fund balances. Cash is designated by the board as active, interim, or inactive for investment purposes. Strict rules govern depository agreements and investments. Investments are either pooled, shared by all funds with a pooled balance, or non-pooled, tied to a single fund permitted to receive its earned interest. Non-pooled investments should only be used when there is a valid reason for the investment to be separated from other invested money. All other investments should be pooled, the fiscal officer's best friend. And last, some funds are not permitted to receive interest. Their interest is always posted to the general fund. This concludes Chapter 3 of UAN Governmental Fund Accounting 102.